thank you for watching my videos. We spent a great deal of time examining the popular currency pairs in the Forex market and learning about how they're different from each other. So what I want to do in this video is I want to focus mainly on individual currencies, because by learning more about the currencies we have a better idea as to how to plan our strategies based on what's happening not only with that currency but the economy that runs on that currency, as well as the data released by the central banks and any data released by the government that runs the central banks. So what I've done in this PowerPoint presentation was I created profiles of the major economies that people study in the Forex market, so we have a better understanding as to how to use fundamental analysis when we are investing in this market. Okay, so here's what's included in these profiles that I created. I've included the facts and figures of the countries and economies, also the overview. So we're learning more about how that economy is operated and the impact that economy makes in the Forex market. Also, we're going to talk about the central banks of each of the economies that we encounter in the market. Also, we're going to cover policy tools, characteristics, and also some indicators that can give us an advantage when we are planning our strategies. So I think it's important to learn about the countries in which currencies we are investing in, because again, fundamental analysis is very important when we are making any decisions about investing in the Forex market. Okay, so let's get started with the first country. Let's talk about the United States of America. Here's what we need to know about the USA. It's the world's largest economy and it plays a serious role in the global market. As I mentioned in the first video, that the US dollar makes up a large amount of the currency that is traded in the Forex market. So we must pay attention to what happens in the United States. Now, here's what we need to know about the US economy. The US is widely considered to be the richest country in the world, producing about 14.2 trillion in output based on stats in the year 2009. Now, the US's main industries are aircrafts, automobiles, transistors, telecom equipment, and other industrial materials. So again, many of the major corporations in the world are either headquartered in the United States or they have offices in the United States. So that also adds to how large and how strong and stable the US economy is in this world. Now, one key element of the US economy is that the country is notorious for running huge trade deficits. So even though the United States has a large economy, sometimes the American government borrows more than what they actually produce. So that can also create a lot of volatility in the market as well. So we want to pay attention to any trade deficits and any debts. Okay, so let's talk about the Central Bank of the United States, otherwise known as the Federal Reserve. It's the governing body in which comes to setting and implementing the monetary policy. So again, we want to pay attention to anything that comes out of the Federal Reserve, because that determines the direction in which the US dollar currency pairs are heading in. Now, here's something else that we need to know. Its objectives are based on a longer time frame, which means more focus on the longer term effects of its monetary policy. So any decisions that come out of the Federal Reserve are based on what should be happening, not necessarily in the near future, but in the distant future as well. And also, there are two main objectives of America's central bank. Keep the prices of the consumer goods and services stable and make sure that there is sustainable economic growth. So what the American government and also the Federal Reserve is aiming to do is keep the economy growing bigger and bigger and bigger. because as the economy grows, the unemployment rate lowers and also our debt lowers. So it's very important for the Federal Reserve to make sure that the economy keeps growing, and also that involves moving the US dollar around into many facets. So again, with the US dollar moving as much as it does, that's why it's also important to monitor the movement of the US dollar in the Forex market. Okay, so let's talk about the dollar. So a huge amount of currency transactions every day involves the US dollar. So we're talking about economies big and small worldwide. Most of them do involve using the US dollar. And also commodities like gold and oil are also denominated in dollars. So we're talking about commodities that are traded in US dollars. And just like I mentioned in the previous video about Japan wanting to purchase imported oil, they have to convert Japanese yen into US dollars in order to purchase the oil because the price of oil is listed in US dollars. Also, the value of the companies listed in the New York Stock Exchange amounts to 28.5 trillion, about 78% of the size of the world's $36.6 trillion stock market. So again, with so many companies, so many large-sized companies based out of the United States, that also creates a demand for the US dollar and also creates a lot of usage of the US dollar. Okay, so here's some economic indicators. So when we are trading the US dollar, we want to pay attention to non-farm payroll. Again, this tells us how many new jobs were created. And the non-farm payroll creates the largest amount of fluctuation in the Forex market. And we get this information the first Friday of every month. Also, we want to pay attention to the gross domestic product, retail sales, and this is also very important, consumer price index, because that also gives us an idea as to how Americans feel about the economy. If Americans feel negative about the economy, Americans spend less. If Americans feel good about the economy, Americans spend more. Also, personal consumption expenditure, that's also important. University of Michigan consumer sentiment. So again, these are also ways of getting the sentiment analysis that we need in order to determine the future of the US dollar's movement. Okay, so speaking of movement, let's talk about what moves the US dollar. Gold, as we covered in the previous videos. Also, any economic developments in the US, for example, the non-farm payroll. Capital inflows and outflows, again, how much are we producing, and the amount that we're producing, is that able to reduce the national debt sum? Also, economic developments around the world. So, as I mentioned in the first video about the reason why the US dollar is so important because of military superpower, when there are conflicts worldwide, it's highly likely that the United States government will intervene in those conflicts. So that also affects what the US dollar does in the market. Also, bond yield differentials. So we want to compare bond yields with other countries, and also rumors about interest rates. So we want to pay attention to the Federal Reserve to see whether or not the interest rates will change. Okay, so what do we need to know about trading the US dollar? As a base currency, the profit and loss are denominated in US dollars. For one standard lot position size, each pip movement is worth 10 US dollars. For one mini lot position size, each pip movement is worth 1 US dollar. So what I just explained to you was the value of the pip when we are trading the US dollars, whether we're going long or going short, if the US dollar is the bid currency. However, if the US dollar is the quote currency, what that means is profits and loss are denominated in the currency of the bid currency. For example, the euro, the pound, the Australian dollar, or the New Zealand dollar, because the US dollar acts as a cross currency in those four currencies. Okay, so let's develop strategies for trading the US dollar. So the US dollar index, or USDX, that tracks the performance of the US dollar versus a fixed basket of currencies. So if we're going to focus on trading the US dollars, we need to focus on the US dollar index. Now, in one of my previous videos, we talked squarely on the US dollar index, and we should know by now how that can help us when we decide to either go long or go short on the US dollar. So the US dollar index, the USDX, that's very important, and we can see how the other currencies stack up against the US dollar, because as I mentioned before about the basket currencies, the euro holds the heaviest amount of weight in the group of basket currencies. Okay, so taking note of the Fed's monetary policy outlook, which is usually part of the Fed's official speeches, could yield some clues about the direction of the US dollar. So whenever the chairman of the Federal Reserve speaks, we should pay attention to every word he says, because that can determine the future movement of the US economy as well as the US dollar. Okay, now let's talk about the Eurozone. Here's what we need to know about the European Union. It's a brotherhood of 27 member states, which started in 1951. Then it grew into the largest economic region in the world. Now, these nations comprise of the Eurozone, which is also called the European Monetary Union, and share the same monetary policy set by the European Central Bank. So we're talking about a collection of countries that share the same central bank, which explains the reason why the European Union is the largest economic region in the world. Okay, so let's talk about that economy. It's the second largest economy with the gross domestic product of 8.7 trillion euros in 2009. And the economy is mostly a service-oriented economy. However, the services render 70% of its gross domestic product. Also, it has a standardized system of laws, particularly for trade. So again, we're talking about a large group of countries that have relinquished a small portion of their sovereignty in order to create a super society where many citizens can benefit. So that's the whole point of the European Union. And also, because of the individual countries are grouped as one entity, it enables them to facilitate trade easier, mostly with its number one trade partner, which is the United States. And this active participation in international trade also has a significant impact on the role of the euro as a reserve currency. So the strength of the Eurozone's economy has also rendered the euro as one of the reserve currencies in the world, along with the US dollar and the Japanese yen. Okay, so let's talk about the European Central Bank. Its main objective is to maintain price stability in the region. And here's how they do that. The nation's inflation rate must not exceed the average inflation of the three best performing states by more than 1.5%. So in Europe, they're very strict about the inflation rate. So we do have to pay attention to what happens in the European Central Bank to make sure if they're able to maintain the inflation rates that they are set to maintain. Also, their long-term interest rates must not exceed the average of these low inflation states by more than 2%. And they must stay within the range of the exchange rate mechanism for at least a couple of years. And the deficit must not be less than 3% of the GDP. So we have one central bank with all of these strict regulations that are held on many different countries. We must pay attention, especially to the head of the European Central Bank, because anything that he or she says can have a really strong impact on the euro, much like anything said by the Federal Reserve Chairman has an impact on the US dollar. So we must pay attention to what these chairmen are saying about their central banks. Also, open market operations, on the other hand, are used to manage interest rates, control liquidity, and establish monetary policy stance. Such operations are conducted through buying or selling of government securities in the market. So also we want to monitor the amount of volume that European securities go through every day, because that can also determine the strength of the EU economy. Also, in order to increase liquidity, the European Central Bank buys securities and pays with euros, which then gets circulated. Conversely, to mop up excess liquidity, the European Central Bank sells securities in exchange for euros. So again, this creates a demand for euros, which also creates a lot of volatility in the Forex market. Okay, so let's talk about the euro. Here's what we need to know. The euro is also known as the anti-dollar, as I explained in the video I done about the US dollar index. Most activity is during the beginning of the London session until the middle of the New York session. So if we want to trade the euro and we want to earn profits on that large amount of volatility, we should trade during the London session and the New York session. Often linked to capital markets such as bonds and equities. As I explained before, a lot of the bonds and securities involve trading with the euro. And the euro often moves in correlation with the Swiss franc, which means the euro-dollar pair is usually in negative proportion with the US dollar-Swiss franc pair, largely because in the euro-dollar pair, the US dollar is the quote currency, and with the US dollar-Swiss franc pair, the US dollar is a big currency, so that explains the inverse proportion. Okay, so let's move on to economic indicators involving the Eurozone. So we need to pay attention to the gross domestic product. Also, we want to pay attention to the unemployment rates, especially in Germany and France, because Germany has the largest economy in the Eurozone. Also, we want to pay attention to German industrial production and German IFO business climate survey and budget deficits. See, we need to pay attention to what Germany does more than the other Eurozone members, because the economy in Germany is so large and so successful that whatever it gets produced out of Germany can have a profound impact on what happens to the euro in the Forex market. Okay, so let's talk about what moves the euro. Well, fundamental reports has a profound impact on the euro, as well as the sentiment of the US economy. So again, we're talking about information from the United States that can affect what happens in Europe as well. Bond spreads between the 10-year bonds of both US and German bonds. Again, we mentioned Germany because they're the most active in the Eurozone. And interest rates on both the Euribor futures and the Euro-dollar futures. Oh, and where I've written Euro-dollar, what that means is the US dollar stored in European reserves. So I know I didn't mention euro-dollar in the previous videos, but I just want to make it clear that's what the word euro-dollar means. There's a lot of confusion as to what it means, so I just wanted to make sure that euro-dollar just refers to American currency stored in European banks. Okay, so let's talk about trading the euro-dollar pair. We need to pay attention to margin calculations that are based in US dollars. For instance, if the current euro dollar rate is 1.4 and the leverage is 100 to 1, that means it will take 1,400 US dollars in available margin to be able to trade one standard lot position of 10,000 euro. So when we are trading lots, keep in mind one standard lot is 100,000 units, one mini lot is 10,000 units, and one micro lot is 1,000 units. So we have to remember that when we are trading the euro dollar pair, the size of the lots are measured in euros, not in dollars. So that can confuse people who are new to the Forex market, and that can also create a lot of disturbance as to why so much money is being lost so quickly. Well, and that's the reason why. Okay, here's something else that we need to know. Pro-euro moves, which typically take place upon the release of strong economic figures from the Eurozone, create opportunities for long euro-dollar trades. So anything that helps the euro move, that's an opportunity to go long. And anything that's anti-euro, meaning any data that gets released from the European Central Bank that hurts the European economy, that's also a good opportunity to go long on to buy the US dollar and short the euro. And also, euro dollar is highly susceptible to retracements. So if you love my Fibonacci video, the euro dollar pair is the perfect opportunity for you to use Fibonacci. Okay, also other euro pairs such as the euro yen, euro franc, euro pound that you can check out. So there are so many opportunities that we have in the market when we're dealing with the euro, because anything that involves the euro can also create a large amount of fluctuation, just as anything that involves the US dollar pair. So study what happens in the Eurozone economies, and study any information that gets released from the European Central Bank, because that can help our investments immensely. Okay, so now let's talk about the United Kingdom. So here's what we need to know about the British economy. In terms of trade, England is the net importer of goods with a consistent trade deficit. Its largest trading partner is the Eurozone, more specifically Germany. And trade activity with the Eurozone accounts for over 50% of the UK's trading activity. So again, we're talking about the Eurozone. So what happens in the Eurozone can have a profound impact on the British economy. So see how everything is tied in? We pay attention to what happens in the American economy, that can affect the euro. What happens in the European economy can affect the value of the US dollar and even the pound and the British economy. So fundamental analysis is very important and also can help us achieve our profits tremendously. Okay, so let's talk about the Bank of England, which is the British central bank. So the BOE is aiming for a target inflation rate of 2% and has been granted the power to change interest rate levels that they believe will allow them to meet this target. So the Bank of England, they have a very strict policy in regards to where their inflation rate should be. So there's a lot of fluctuations in the interest rate in order to make sure that the inflation rate stays at 2%. Now, the bank repo rate is the rate set by the Bank of England for its own operations. In England, the interest rate is what they call the repo rate. So that's why I use the term repo rate. So in the market to help meet the MPC's inflation targets. Like other central banks, if the Bank of England raises the repo rate or interest rate, they are aiming to curb inflation. On the other hand, if they lower the rate, they are aiming to stimulate growth in the economy. So now let's talk about the British pound. So the pound dollar accounts for 14% of the global trade which is the third most active pair targeted. So it's also a good opportunity to make a large amount of profit when we trade with the pound dollar pair because of the amount of fluctuations caused by what happens with the Bank of England, the British economy, and any information released by the Bank of England. Having some of the higher interest rates amongst the major currencies, investors may find British securities to be more attractive. So again, we are studying bond yields and bond spreads. This is very important when we are planning our investment strategies. Also, the pound dollar trading volume is the highest during the European session with potential for strong moves during the New York session. So we want to focus, if we choose to invest in the pound dollar pair, we should focus on the London session and the first part of the New York session, maybe the first half of the New York session. That's where we're going to get our most amount of volatility in this currency pair. Okay, so also here's what we need to know about the British pound. They're very prone to volatile moves because of its lower level of liquidity compared to that of the euro. So let's talk about economic indicators. So any information about the unemployment rates, about consumer price index, the GDP, or the purchasing managers index, or just anything that involves sentiment analysis. Because just like the Americans, if British people don't feel right about their economy, they'll spend less. If they feel good about the economy, they'll spend more. So that type of sentiment analysis can help us make a big profit when we are investing in the British pound. Okay, so what moves the British pound? Well, changes in the monetary policy, also developments in the Eurozone and the US, also the spillover effect. What I mean by the spillover effect is anything that happens at the end of one session that carries over into the beginning of another session. So we want to be careful about trend continuations when we're dealing with the British pound. Also, trading the pound dollar pair. Here's what we need to know. Take note of key reports that come out because the British pound pairs tend to react more strongly to economic reports. So, and also keep this in mind with the value of the British pound being much higher than that of the euro. It's also recommended that to new investors to use caution when we are investing with the British pound, because also remember the lot sizes are larger because the size of the lots are measured in British pounds. So if you're a new investor with small amounts of capital, it's probably a good idea to avoid trading with the British pound until we get higher amount of capital. Also, the pound dollar and the pound yen pairs, they are the most volatile among the majors. In fact, the pound dollar moves around 160 pips per day on average. So for those that like a lot of volatility, that want to make quick profits, it would be prudent to study what happens in the pound dollar pair, because you can catch a lot of quick profits in this pair. Okay, so now let's move on to Japan. So here's what we need to know about Japan. They've experienced a rapid economic growth since the end of World War II. Also, they don't have a lot of natural resources, so they have to depend on technology in order to boost their economy. And they've done that very successfully. Also, Japan benefits from China's massive growth as well. So with Japan being the nearest major economy, Chinese demand has led to massive shopping sprees of Japanese products. So we're dealing with, well, right now, the second largest economy in the world, which is China. Japan being so close to China, that means a lot of people in China are more likely to spend money on Japanese products. Now, in order for those stores to have Japanese products in their shopping malls, they need to convert their local currency into Japanese yen in order to get those Japanese products. So again, we're talking about China, the world's largest population, second world's largest economy. So as we can see, the demand for the Japanese yen is extremely high. Okay, so let's talk about the Bank of Japan. That's the central bank created by the Japanese government. It's similar to other central banks. The Bank of Japan's main objective is that of price stability. They make use of open market operations and interest rate changes to meet their goals. Also, they keep their interest rates at low levels. And currently, the interest rate is at 0.1%. Now, because the rate is already so low, the central bank cannot decrease the rate to stimulate growth or create liquidity. So 0.1%, that's as low as they can go. Okay, so here's what we need to know about the Japanese yen. After the US dollar and the euro, the Japanese yen is the most heavily traded currency, with the dollar yen also ranking as the second most traded currency pair. So we've already covered as to why the demand for the Japanese yen is so high. Also, with Tokyo being one of the world's major financial centers, Japan is often the representative of what's happening in Asia. Now, there are other financial markets in Asia, such as the Hong Kong market, Shanghai market, Singapore market. However, what happens in those markets can have an influence as to what happens in Tokyo. So pay attention to what happens in the Hang Seng or the Singapore's market or Shanghai's market. So these are also key elements in order to develop a successful strategy if we choose to invest in the Japanese yen. Also, Japan is normally a major trading partner of other Asian powers, such as China, as I covered a minute ago. Now, many investors have resorted to carry trade. Now again, with the interest rates being low, if we short the Japanese yen by going long on the currencies that are the bid currencies, we can make a significant amount of profit just by carry trade, as I explained in the previous video about carry trade. Okay, so now let's talk about China and what they have to do with the Japanese yen. With China emerging as a major power in the world, its influence on the yen will continue to grow. If signs point to further growth in the Chinese economy, it may affect the demand for the yen. So remember, we want to pay attention to any data that comes out of the Chinese government as well as Chinese banks, because that can give us some really good fundamental analysis as well. As Chinese businesses boom, they will need to order more from Japan. This in turn would increase demand for the Japanese yen, causing it to appreciate. So again, what happens in China can also affect what happens in Japan. So, economic indicators. We want to pay attention to the gross domestic product as of any other major countries. Also, we want to examine Tankan surveys. Again, this is just a way of determining the sentiment analysis among Japanese consumers. Also, trade balances, unemployment rates, consumer price indexes, and here is a very important one, core machinery orders. You see, Japan produces their technology in factories, and those products are usually created with machineries or with robots. Now, those machines, they break down, so they need to replace those broken machines with new ones. So every month, Tokyo comes out with a report as to how many machine parts were ordered. If the number of machine parts are rising, it means Japan is producing more technology. if the number of machine orders, the new machine orders, are decreasing, it means Japan is not producing as many products as before. And remember, Japan's economy is based solely on how much technology they can produce. So also keep that in mind when we pay attention to the machine orders. This is most likely the most important element when we are trading the Japanese yen. So remember that, machine orders. Okay, so what moves the Japanese yen? Investment moves and the BOJ effect. So remember, we want to pay attention to what the chairman of the Bank of Japan says, because anything that comes out of the mouth of the chairman of the Bank of Japan can have an impact on Japan's future and therefore the future of the Japanese yen. So, how do we trade the US dollar Japanese yen? They tend to follow the short to medium term trends, which could last a few days. So, this goes along with the previous videos that I've done about the Nikkei and the Dow and its relationship with the US dollar Japanese yen pair. So there's a lot of correlation between how the US dollar is doing and how the Japanese yen is doing, which is another reason why this pair is a very popular pair to trade on. Once price begins to consolidate, you can close your position and wait for another trend to develop. So when people get involved in the US dollar Japanese yen pair, it's highly recommended that we look for trends, because the US dollar Japanese yen pair, they often move in trends. There's usually an uptrend, and once that uptrend stops, then it ranges, and then maybe another uptrend or another downtrend. And trends happen very quickly in this pair. So if you are a day trader or an intraday trader, this is also a good pair for you to trade on, because there's a lot of volatility and the trends in this pair are very strong. Also, Japanese industrial companies normally set their orders at round figures, like $100 or 100 yen or 90 and a half yen. So that's also something that we need to pay attention to when we are studying the US dollar Japanese yen pair. Also, what happens on the other yen pairs is important too. The euro yen pair, the pound yen pair, that has a profound impact on the US dollar Japanese yen pair. So if you go back to my previous videos where I talk about the euro yen pair and its correlation to the major stock indices, you can understand why. Okay, so now let's talk about Canada. Here's what we need to know about the Canadian economy. The Canadian economy is based on the export of its own natural resources, particularly oil. And it's also a G8 country. It's the 5th largest producer of gold and the 14th largest producer of oil. And despite its robust industrial and manufacturing industry, much of Canada's GDP actually comes from its service sector, which accounts for almost 70% of the GDP. So we're talking about a country with large amounts of resources and a high gross domestic product. And Canada sends 80% of its exports with the United States, which gives us an idea that what happens in the American economy affects the Canadian economy and vice versa. Okay, so let's talk about the Bank of Canada. This is the central bank of the Canadian government. So the BOC doesn't have a set time to make changes on its policies. So what this means is the chairman of the Bank of Canada, they can make their speeches at any time. So don't be surprised when you hear that the chairman has made a speech and you weren't expecting this person to make the speech and you just completely missed it. So if you are interested in investing in the Canadian dollar, be very vigilant as to what happens in the Bank of Canada because data can be released at many different times. Also, the Bank of Canada implements its open market operations by using a method called the Large Value Transfer System. The LVTS enables commercial banks all over Canada to borrow and lend money to each other so that they can go about their daily operations. So, again, with this type of activity, this spreads the Canadian dollar largely to many places, thus creating a demand for the Canadian dollar. Now, about the Canadian dollar, the price of oil has been correlated to the US dollar Canadian dollar. I showed you in one of the previous videos the correlation between oil prices and the US dollar Canadian dollar pair. And the US Canadian dollar pair has been known to move in tight ranges for most part of the day. It is only when US traders are waking up during the day to overlap of the European trading session. So what this means is we're talking about when the US dollar Canadian dollar pair is the most volatile. The most amount of the volatility usually takes place in the beginning of the New York session. And a key factor to look at when trading the US Canadian dollar is that the direction is closely tied to that of the US economy. So what happens in the US economy and also the data that gets released can also have a profound impact on the value of the Canadian dollar. So here are some economic indicators. We want to compare the consumer price index, the gross domestic product, trade balances, and also the EV purchasing managers index. So again, these are just examples of the types of fundamental or sentiment analysis that we can get and use that to apply to our trading strategies that involve trading the Canadian dollar. Now, going back to the Purchasing Managers Index, what that is, it's a survey designed to see whether businesses are optimistic or pessimistic about the economy. So again, we're dealing with sentiment analysis. So the Bank of Canada, they seem to have a system or a tool that is designed to measure how Canadians feel about their own economy. Okay, so what moves the Canadian dollar? US economic data, mergers and acquisitions. Pay attention to those because what happens in the news can affect what happens to the Canadian dollar. So much of the US economic data and the mergers, we can get that from pretty much any news source. Okay, trading the US dollar Canadian dollar. It's only active during the US trading session. Well, you can trade it during any session, but the most amount of activity is during the New York session. And because the pair is highly susceptible to fake outs during the other two trading sessions. So if you're looking for volatility, trade during the New York session. Because if you trade during the Tokyo or London session, there's not too much volatility and it's very difficult to use technical analysis in order to get an accurate reading. And if we do apply technical analysis, we'll probably get a lot of fake outs and wrong readings. So keep that in mind if you want to trade the US dollar Canadian dollar. Also, watching the differences in the results of economic data between the two countries is also a great practice to determine where this pair is headed. So comparing the US economy and the Canadian economy, that will also help us develop our strategies more. Now, let's move on to Australia. Australia, like Canada, is also a country that produces large amounts of its own natural resources. As I mentioned in the previous video, Australia is one of the world's largest producers of gold. So, let's talk about the Australian economy. So, here's what we need to know, that in the past 15 years, Australia's economy has grown an average of 3.6 per year, as well as above the 2.5% world norm. So we're talking about fast and very successful economic growth. Australia's economy is a highly service oriented, like Canada, with almost 69% of its gross domestic product coming from industries such as finance, education, and tourism. Also, even though they have a robust export industry and stellar growth, Australia has been notoriously famous for consistently having high current account deficit. So, just a little bit of good and bad about the Australian economy. It's been successful over the years, but there are still some flaws with the Australian economy. Okay, so let's talk about the RBA, Reserve Bank of Australia. That's what they call their central bank. Here's what we need to know. They have three goals: keep the exchange rate stable, ensure growth, and maintain full employment. So they want to lower that unemployment rate as much as they can. Also, the bank believes that keeping the inflation rate within 2 to 3% helps the Australian government achieve those goals. Also, they control inflation by adjusting the cash rate and condition open market operations. Now, let's talk about the Australian dollar. So, the Australian dollar has a high positive correlation with gold prices. So I mentioned in the previous video that I did on commodities. Now we understand fully why it's important to study commodity charts. Because what happens in the gold market has a profound effect on the Australian dollar, especially the Australian dollar US dollar pair. So study those gold charts and study those oil charts. High interest rate markets makes the currency popular for carry trades. So many people, they want to invest in the Australian dollar because that Australian dollar carries a high interest rate, and use that to go long against a currency that has a significantly low interest rate. So carry trade. Also, the Tokyo session is the busiest time for the Australian dollar. That's self-explanatory because the Australian markets are open at the similar time as Tokyo opens their markets. Okay, and now let's talk about economic indicators. So we want to pay attention to the consumer price index, balance of trade, gross domestic product, and unemployment rate. This is a big deal in the Australian economy because the government aims to keep that unemployment rate as low as they can. If the unemployment rate rises too high, that means the people of Australia lose confidence in their government. Okay, so what moves the Australian dollar? Economic and interest rate outlook, China's economy, because a lot of the natural resources that are produced out of Australia, that gets used in China so they can make the products in the Chinese factories. So there's a lot of cooperation between Australia and China. So pay attention to both economies before we develop a strategy on trading the Australian dollar. And New Zealand data as well, because of its close proximity between Australia and New Zealand. Not just proximity, but even cultural ties, because they're both members of the British Commonwealth. They both used to be British colonies. They both speak English. So, sort of a cultural bond between the two countries. Okay, so how do we trade the Australian dollar, US dollar? Well, it's highly affected by crosses. So it also helps to study the activities of other currencies. Also, positive economic data from New Zealand usually helps push the Australian dollar's value up. And whenever the gold rises in value, the Australian dollar, US dollar could rally soon after. So again, as we mentioned before in the previous video, there is an inverse proportion between the direction of the gold market and the direction of the US dollar. Gold goes up, US dollar goes down. Gold goes down, US dollar goes up. And because the US dollar is the cross currency in the Australian dollar US dollar pair, That means if the price of gold is bullish, the gold market is bullish, means the Australian dollar US dollar pair may also be bullish. I can't say will because nothing is 100% in the Forex market. So let's change that vocabulary from will to most likely. So if the gold market is bearish right now, then the Australian dollar US dollar pair will most likely be bearish. And here's some information about New Zealand. So here's what we need to know about the New Zealand economy. Its gross domestic product, which is valued at 182 billion New Zealand dollars, makes them 60th among the world's economies. The economy is heavily dependent on trade. So we're talking about a small country that doesn't have a large amount of its own natural resources, and even though it's the 60th largest economy, meaning it doesn't really have a strong impact on the global economy, there are still some factors that make New Zealand's currency attractive. So it is important to study New Zealand's economy. So its primary industries are agricultural and tourism, and they only have a small manufacturing and technology sectors. So again, we're dealing with a small economy, but again, we're going to, as we gain experience in investing in the Forex market, we can begin to understand why New Zealand is important. And the World Bank considers New Zealand to be the second most business-friendly country in the world. So what this means is many foreign businessmen enjoy doing business in New Zealand. Okay, so let's talk about the Reserve Bank of New Zealand. They hold monetary policy meetings 8 times a year, and to achieve price stability, they must ensure that annual inflation meets the 1.5% standard, the official cash rate, which affects the short-term interest rates, that is set by the governor of the Reserve Bank of New Zealand, or the chairman of the RBNZ. They just call it governor, different words. Okay, so let's talk about the New Zealand dollar and how to trade it. First, the region is linked to commodity prices. If the commodity prices rise, then the amount of money paid for New Zealand's export also rises. The economic performance of Australia has an impact on New Zealand. So we're dealing with two countries with cultural ties, and interest rate differentials between economies also often serve as indicators of money flows. So this information that we're getting from New Zealand, their government, and their Reserve Bank gives us an idea that New Zealand has a stable economy. Many foreign investors trust the New Zealand banks and the New Zealand dollar. So these are key factors as to why New Zealand is important in the Forex market. Okay, so some economic indicators: gross domestic product, consumer price index, and balance of trades. These are the 3 things that we must study in order to understand how the New Zealand economy works. Okay, what moves the New Zealand dollar? Economic growth, surge in exports, and rising commodity prices. So if we plan to invest in the New Zealand dollar, we need to study these 3 factors to get our fundamental analysis. So how do we trade the New Zealand dollar, US dollar? Well, strong economic reports from New Zealand result to an appreciation of the New Zealand dollar. So if there's a good chance that any economic release could beat the consensus. So what we're looking for is any data reports that are better than expected, because anything that's better than expected out of New Zealand can create a bullish trend for the New Zealand dollar. Also, most of the time, commodity prices surge when demand for riskier assets is strong. So during these times, investors place their money in higher yielding assets such as gold and other commodities and sell the lower yielding US dollar. So again, we're dealing with carry trade. exchanging a financial instrument with a low interest rate and using that to gain or purchase a financial instrument that gives us a higher interest rate. And also, just like the Australian dollar, the New Zealand dollar is also a good candidate for carried trade, as I mentioned previously. So now let's move on to Switzerland. So what makes the Swiss economy so special in the Forex market? Well, Switzerland is one of the richest countries in the world in terms of per capita income. So the citizens of Switzerland are living well compared to many different countries in the world. Also in 2009, it produced 488 billion US dollars in total output. As small as it is on a per person basis, it boasts a gross domestic product of 43,195 US dollars, which is the 7th highest in the world. Also, like Japan, Switzerland is highly dependent on its exports, which makes up about 247.2 billion, or more than half its gross domestic product. So what we're dealing with is a country that doesn't have many natural resources of its own. The size is small, but what Switzerland exports is also very important to their economy, because their exports is what makes their currency, the Swiss franc, strong. Okay, so let's talk about the Swiss National Bank. The SNB sets a target range for its desired interest rate rather than a fixed figure for 3 months. And an excessively strong franc could cause inflation to spike and could also undermine the country's exports. So what the Swiss government does not want is for the franc to be too strong, because if the franc is too strong, then many consumers are less likely to purchase Swiss imports or products that are being imported into their country. So what the Swiss National Bank, they're trying to do is they're trying to make sure that the value of the Swiss franc doesn't grow too strong. So they need to keep the value stable. And corporate tax rates in Switzerland run from 8.5% to 10%. This, in addition to its bank secrecy laws, makes Switzerland one of the most business-friendly nations in the world. Also, because of its low tax rates, Switzerland is also viewed as a tax haven nation. So many people are very interested in investing in Switzerland and in Swiss banks because of its low taxes. So that's another factor that makes the Swiss economy so strong and so attractive, and creates a high demand for the Swiss franc. Now, let's talk about the Swiss franc. Switzerland is considered to be politically neutral due to its bank secrecy laws, which also means that the Swiss franc is a very trusted type of currency. So again, we're talking about a currency that has maintained its strength because the economy and their banks are very successful. Also, it's the only country that still adheres to a gold standard. So also, we want to study what happens in the gold market. That also affects the value of the Swiss franc. And about 1/4 of the country's money is backed with gold reserves, giving the Swiss franc 80% correlation with the price of gold. So remember in the previous video, study those commodity charts. Okay, let's talk about economic indicators. So when we're dealing with the Swiss economy, when we're trying to extract the fundamental analysis that we need in order to develop investment strategies involving the Swiss franc, we must pay attention to the gross domestic product, retail sales, consumer price index, and the balance of trade. And what moves the Swiss franc? The price of gold. So again, study those gold charts. The development in the Eurozone and in the United States, mergers and acquisitions. So this information we can get, or all three types of information, we can get these from any news source. And trading the US dollar Swiss franc, the Swissy pairs, which are the US dollar Swiss franc and the Euro franc, are usually active during the European trading session only. So if we're looking for volatility in any pair that involves a Swiss franc, you'll find your volatility when the European markets are open. And the Swiss National Bank is very much keen on monitoring the valuation of the Swiss franc. They're known for intervening in the Forex market only to weaken the franc, especially when it reaches some historical key levels. So again, one of the goals of the Swiss National Bank is to make sure that the bull market is not a runaway bull market. Because again, if the Swiss franc is too high, the exports, which is what Switzerland needs in order to maintain their successful economy, those Swiss exports that are imported into other countries, many consumers are less likely to purchase them because the merchants are more reluctant to exchange their local currencies for Swiss francs in order to get the products out of Switzerland and into their stores. Okay, so again, it's very important to study the economic profiles of the major countries that are involved in the Forex market, because we need to know exactly what is the driving force behind each currency. Because by studying the driving force, we can get a large amount of analysis and a large amount of knowledge that we can use to plan our strategies successfully. For example, on our trading platforms, we have tools that we can use to measure technical analysis. However, there's not too many tools that we can use to measure fundamental analysis and sentiment analysis. There's not as many mathematical formulas or scientific calculations that we can use to get that fundamental or sentiment analysis, in which they are equally important with technical analysis. So we need every advantage we can get. Investing in the Forex market is a very difficult thing to do. It looks easy, but it's very difficult. There's so much knowledge that we must accumulate, and that knowledge comes from many different sources. We have to look at the American sources, the Canadian sources, the European sources. And the European sources, we have to break that down into sources out of the UK, France, Germany, Spain, Switzerland, and all of that can be really confusing. So we must take some time to learn about the individual economies, learn about the cause and effect, what affects the economy and what the effect on the economy causes. So, and then not just economies, but data reports, what gets released from the governments. We must pay attention to everything that is said by representatives of banks, governments, and even individual corporations that have invested a large amount of their assets in the Forex market. So we have to keep in mind that all this information that I'm giving you in these previous videos are designed to give us whatever advantage we need in order to make our investment successfully. Thank you for watching my videos, and good trading.